Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. I'm excited to announce our upcoming schedule of Planet MicroCap showcases, our investor conferences showcasing our microcap community. We will be hosting the Planet MicroCap Showcase virtual on December 6th through 8th, 2022, and we'll be back in Las Vegas for our in-person event on April 25th through 27th, 2023. Attendance for both events are complimentary for investors, and expect to interact with microcap management teams, watch and hear insightful keynotes and panels, plus network with your fellow microcap crew. Registration is now open for our virtual event, so to join us, please visit www.planetmicrocapshowcase.com. For this episode of the Planet MicroCap Podcast, I spoke with Maj Soueidan from geoinvesting.com and Quim Abril, portfolio manager at Draco Global. I haven't had Maj on the pod for a little bit, and it's been a long summer with a potentially longer winter ahead of us, and I wanted his thoughts on navigating our current microcap environment. Maj also recommended having Quim Abril on the show to give his take as well and talk about his investing course geared towards native Spanish speakers. We discuss in depth that right now at this point in 2022, when looking at microcaps and any potential investment, Maj and Quim are focusing on KPIs, key performance indicators that the company can show that indicates their business success, growth, or lack thereof. It's easy right now to get wrapped up in so many different data points at both the macro and individual company scale. So being able to lock in on information that one can clearly see the overall performance of a business. Quim and Maj give a number of real-time examples to demonstrate what they mean by this. We also talk about overall pessimism in microcaps, thoughts on why, and as demonstrated with honing in on KPIs, what we can do about it. Thank you again for tuning in to episode 242 of the Planet MicroCap Podcast, and please enjoy my conversation with Maj Soueidan and Quim Abril. This episode is brought to you by Stream by AlphaSense. You can find them at streamrg.co/PMC. That's STREAMRG.co/PMC. Stream is an expert interview transcript library that is starting to become an integral part to investors' research process. They have a number of interviews on a wide variety of companies, including TMT, consumers, industrials, real estate, and more. Stream provides over 300 expert interviews per week, and 70% of their experts are found exclusively on Stream. Stream is unlike any other transcript libraries. Stream integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Stream's community of experts and thought leaders partner with Stream to build their professional brands and expand their industry influence. Right now, there are approximately 8,500 plus call transcripts available. For more information, please visit www.streamrg.co/PMC. That's STREAMRG.co/PMC. Welcome back to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And joining me today are two guests, one of which, I kind of know him a little bit over the years, like whatever, but also someone new to the podcast who I'm very excited to introduce. I'm excited to have Maj on here too, of course. Don't get me wrong. But we got Maj Soueidan from geoinvesting.com, as well as Quim Abril from Draco Global. Dudes, what goes on? How you guys doing?
Good, Robert, thanks, man. Thanks for, it's been a while since we talked, so this is good.
Yeah,
we seem to say that all the time. Every time we do this, it's been a while since we talked. That's what we say every podcast.
Literally. Literally each time. And by the way, I got to give you, I'm going to apologize and also make it up to you, is that one of the recent pods that we had on the due diligence series, Richardson Electronics, I found out about that name from you. So I appreciate everything that you do and everyone at the team at Geo Investing. So I'm giving you kudos now for that.
I'd appreciate it if you do that. You would wait till it went up first, then do it.
Well, I'd have to get
now I'm on the record. So,
next time.
But although the stock, I think right now it's about $17 or whatever, or I'm sorry, 15.60. I hit 18. Just we've been talking about Geo since about $12, I think, $12. So we got a little nice chunk of profit in it right now. So
I just got Ed's book. Did you get Ed's book yet? Are you on the
Are you
on the early mailing list?
I saw that. Yeah, so should be an interesting read. Yeah.
I just got it.
A lot of history there for him. Yeah,
that's 100%. And Quim, dude, thanks for joining us. Listen, I'm sorry you're getting. There's a lot of inside jokes here between me and Maj from knowing each other over the years. But hey, man, it's good to have you on here.
No worries. I'm just trying to fill in. So I understand you very well, but the Maj English is not the best, right?
I gotta tell you, Quim, already your English is way better than Maj's. Let's just be real.
Especially when Maj is joking, so it's not really easy, right?
Yeah, that's for sure. Never joking.
No, he's never joking. He's very. But anyways, Quim, before we get into, because I brought you guys on here today because I look, like we said, it has been a while since we've had, Maj on here, and obviously our first time interviewing you, Quim. But I want to kind of get your guys' feeling and flavor and take on, obviously microcaps have gotten killed this year. Wanted to see where you guys were at with that. But before we get into it, so that people know who you are a little bit, Quim, can you give us that quick background on who you are and your fund, Draco Global?
Okay, so I'm located in Spain, in Barcelona. I was working in this business from the big tech bubble. So I remember that my first job was at 22. I was doing my master's related to business and financial markets, and then I'm going started to an asset management here at that time. So it's not the best time to be in the market because people was really crazy here. But before going to like a professional profile, I used to invest my money in the companies that right now I'm not investing. Like you can imagine, like high growth companies that you have big expectations for business growth. So I learned with some experience in the tech bubble. And then I'm just starting in data asset management in 2001, 2002. And then I was in 3 or 4 different asset management here in Barcelona and in Spain, sorry. The good thing is when I started in asset management, I started in equity. I'm not starting in fixed income or alternative, and then I'm moving to equity markets. And where I started my first asset management, there are a vacancy in small caps segment. So this is perfect for me because I'm just starting in the small cap segment. So my first role in my asset management is to travel around Spain to visit companies like, maybe you don't know, like companies like Vidrala, Viscofan. And this kind of companies are the quality small cap companies in Spain, but the universe of companies in Spain that you can invest maybe are 40, 50, or maybe right now are more, maybe are 60, but at that time could be 40. And my work is to travel to talk with the CEOs, the CFOs of these companies to try to understand very well that companies, because my universe was really small, and then to try to reach and decide if that companies could be a good investable for the funds. Then I moved to European stocks at the same time for small caps. And then at 2017, I know some guy from one big investment bank in London, because for my job in this different asset management, I used to travel to London because to meet CEOs, to meet management. And I used to work with three different asset investment banks, and in one of these I meet one guy who is really famous right today and who is still in the investment bank, and he proposed me to create a hedge fund and to join forces because he thinks that with his macro style and my micro style we could make a better job together. And it should, so for me at that time, this is a good real idea and proposition, but they want to start with a high assets under management because he's a famous person and they want to start from zero, right? So we start to work in the fund, and we make different roadshows to New York, Frankfurt, London to present the fund to Goldman Sachs, to Morgan Stanley, to JP Morgan, to all the most famous or typical prime brokers in this kind of cities. But at the end, we never reach more than 20 million. So we decide not to start with the project. And this is the idea for me to say, okay, why not? I could do the same, but here in Spain, like more local. And this is because in the 2017, I start my own hedge fund, not a fund. So I'm starting a hedge fund in Malta. Malta is an offshore location here in Europe. It's a typical place that you are going to set up a fund. If you are bigger, so if you start with a high assets under management, you can go to Luxembourg, but you need at least 15, 20 million euros right now. Maybe it's easier for small managers move to Malta and you can start with one or two. The problem is that this is an investment fund, so a professional fund. So retail people cannot invest in this kind of funds. And for me, that was a problem with customers here in Spain because they can invest in the hedge fund. So at the end of 2020, I decided to switch the hedge fund for a mutual fund here in Spain. This is Draco Global, and this is the fund that I'm right now. And the fund is specialized in micro small caps, especially in the US, but also I'm investing in the north of Europe, like Sweden and Norway, Finland, and the UK. Right? And this is my biography across the time.
Nice. All right. Well, hey, man, welcome to our wonderful wide world of microcaps. We're happy to have you. And, we're also a little bit later, I want to talk more about, one of the other reasons that you came on the pod today to talk about the course that you are working on that you want to bring to the US as well. So we're going to come back to that because first, now that we set the stage, I'm going to come to you, Maj. How are you seeing the market, man? I haven't seen you since Vegas. How's the summer gone for you? What's been kind of your take based on how microcaps have performed, not just so far in 2022, but even just this summer?
Bobby, I'm not a market timer so much. And so I just basically, and as Kim will tell you later, the market usually goes up, although I think he's hedging, and we'll get that in a little bit. Yeah, man, look, I just think, I don't want to beat a dead horse here, but I think we've said that the market we were in the last 15 years or so was unsustainable. And we're getting, we've been waiting for this moment of capitulation where everything just like resets and falls apart. All the, the big caps, the tech companies that, were just trading at insane valuation multiples on their price of sales, even though their earnings weren't that fantastic. A lot of debt on some of these balance sheets. They were using debt to grow. Now rates are going up, so all these stocks are coming down. And what you really need now, is I think that a really good stock picking process, and I think the old school boring kind of growth plus value type of situation is where I want to be at right now, and that's what I'm looking for. So I'm just looking for typical situations where we have companies that are growing revenue at a reasonable rate. And what I'm looking more for on the cash flow side and on the operating leverage that can drive earnings. So I'm looking for a little bit of some side of sales growth, a little bit of obviously operating cash flow, and then earnings per share growth. I'm looking for the trio if I can, and then just valuing stocks traditionally on their cash flows and their earnings. And I think that's in times of uncertainty, that's what you need to be looking at, and I think that's the kind of stocks that are going to do well in this market.
Absolutely.
And you're seeing it here, and so that's basically, Bobby, where's the market going to be? Who knows? I mean, I have opinions, and it doesn't matter really. I just think that as we keep going through this type of adjustment period, that stock picking becomes more and more important, and over time, you're going to have those stocks do good no matter what the market condition. And I think we're kind of getting to that. The first part of that reset, everything goes down, right? Everything goes down. It doesn't matter what the company is, and that's what you saw a lot. And now you have to go through the rubble and start figuring out, okay, what shouldn't have went down, and that entails a lot of really deep research and reading the releases, conference call transcripts, SEC filings, interview management, and being on that pulse pretty quickly, and really looking for companies that have a good long-term plan too. You can still buy companies for the short term, I guess, and look for catalysts, inflection points, but I think I want to be in companies that can withstand some turbulence in the short run and still be survival long term. And I think that's really key right now.
For sure.
But things can change in a dime, Bobby, right? We can wake up tomorrow and the euphoria can come back again. And then it will cycle back again, right? And that will come back into vogue again. Yeah. But I just had never seen a market like we had for the last 15 years. It was really weird to me to see the traditional kind of growth plus value strategy is not really working on a broad sense for the smaller cap companies, and I think you're going to see a lot of consolidation. You're going to see a lot of companies get acquired. I think because what happens in these situations, you are seeing them right now. You're seeing a bunch of them, USAC, CCOM, go on and on. But what could happen here is because there's such a fear in the market now, some of these great companies aren't going to get valued at their appropriate valuation, probably, right? And so you're going to have these really low PEs on some of these great stocks and potentially. But if you're willing to value the company on 3 or 4 years earnings out, they might look very cheap. And the company might just sell the stock. We'll sell the company right now because we're not getting any respect. So it might be worth, you might see some big premiums though, because some of these companies might sell for a much bigger premium and a takeout based on, the real value of the company, 3-4 years out.
It's interesting. That's on the due diligence series, I've been going back and forth on whether or not I want to include a final question, especially as things exist right now of all right, well, what's, obviously you can't allude to whether or not, you're actively selling the company right now, but are you trying to empire build or are you taking calls? Because most of these microcaps, you definitely, if they're worth anything or there is some sort of value there, the sharks are feasting. I mean, are you actively looking at new ideas or you've been adding to your adding more?
Oh, yeah, for sure. Yeah. I'm always building my pipeline. I want to have a pipeline. I don't want to wait till the market comes back to have that pipeline started. I want to do it now and have a list of stocks I like right now. And so I'm not aggressively adding new positions. I have been doing that. I've been shedding positions I don't like in my portfolio and being nimble in new positions. I usually like to take concentrated positions, but right now I'm easing in than I am anything else. Because it takes me back to when we had the .com bust, and I had at that time I must have had 300 positions or so. It was crazy, And I would go back interviewing the companies, and you'd have your top maybe 20 or whatever. And literally, even the management teams didn't really know what was going on. So I would interview them, and a week, everything's great, and a week later, everything's falling apart, right? And the sentiment can change in a dime like that. So you got to be really careful about being too optimistic about some of the things that management teams might be telling you right now. Mm-hmm. That's why it's important to think about 3 to 5 years out, maybe, for some of these companies.
For sure.
That's and you'll hear all the time on conference calls, we're doing great. We haven't felt the effects yet. So that yet is scary. So I'm definitely looking for companies more so that are recession resistant, or and I have a few of those in my portfolio where my bigger positions are right now, where actually recession might help them actually to some degree. Sure. Those are out there, and I guess that's going to be interesting how it all plays out. But I think Quim has some ideas about where the market's going, and I think he has a strategy he's employing right now.
Yeah, I want to hear
pessimism.
I know. I want to hear it. Quim, fill us in here. I'd love to hear your take as well.
Okay, for my part, so my macro outlook, so it's not really good, at least for the second half of this year and maybe first quarter of next year. So I'm always long to the market. So I am always invested 90%, 85% of my fund in stocks. So I like to have some liquidity to buy some ideas. But what I'm doing is, okay, I know that 80% of the time, 85% of the time, markets go up. But there are times where markets are not going up. And 90% of that times when markets go down is because there are recession. And in a recession, makes sense to reduce risk. In my case, what I'm doing is, okay, I'm long my stocks, always the same, but I used to implement a tail risk strategy to try to minimize the possible downturn. Because why? So central banks are reducing or eliminating liquidity. They are increasing rates. The economy is in deceleration. And the US is in recession. Maybe Europe is going to start in recession at the end of this year and maybe next year. When I see the estimates are not reflecting this recession macro environment, so it don't make sense. So they should to revise maybe 20-30% below. So at that time and only at that time, I'm using to buy put spreads or they are out of the money. I buy that strategy when VIX is below 20, 19, not when VIX is at 30 because it's really expensive. And this is just a complementary strategy to say, okay, if markets go down 50%, I'm expecting to go down 20%, but not 50%. So buy and hold, it's okay, but there are times that you don't want to buy and hold. And I remember the financial crisis when S&P goes down 60% from max to minimum. I remember very, very clear the tech bubble. This is because I'm implementing this strategy. But 90% of my time is researching companies, stock picker. I'm the same than Maj. I like companies with some kind of not very cyclical, or they are not moving across the business cycle. I all searching for 5 attributes. Like I want a scalable business. I want a business that is not dependent for growing to the business cycle. I want some kind of recurring revenue, and I want a business that they play in attractive sector structure. Right? This is my main philosophy for stocks. And the last one, and maybe new, is I'm all investing in stocks that I can reach a KPI, not ROA. So I'm talking about a business KPI. I don't know. For example, if you invest in Medifast I think is a really good investment company. Maybe right now is not the best because you have to pay $500 a month for the Medifast subscription, and maybe if you are in a recession, you are not planning to enroll in a nutrition plan. But Medifast is the typical company that in his press release they report each quarter the 2 KPIs, who is the commercial network, who is the number of coaches. Coaches is the people that supports customers, and then the second one, who is the average revenue per coach or the productivity. So it's really easy for me to try to estimate the future revenues if I know these 2 KPIs, because I'm not modeling the revenue growth. What I'm modeling is the number of coaches and the productivity. So if you are looking, for example, right now, one of my best ideas is PaySign. I think maybe both, that time. I'm wrong with the time because I try to invest at the end of 2020 at PaySign, because remember that Grifols, who is one of the biggest players in plasma business, Grifols and CSL, but Grifols, the headquarters was in Barcelona. So I meet many times with the management of Grifols. So I understand, I think, very well the plasma business. And I think right now, PaySign has the best conditions that you can have. So I think that the best investment is not in gas, is not in oil. I think right now is in plasma, because if you read different news, if you talk with the management of PaySign, from the end of last year and from these 2 quarters, the traffic from people to the centers is growing more than double digit. The productivity, the revenue per center, is it growing? And right now it's across 500,000 a month. So and remember that. So US is in recession. So from now to the end of the year, and maybe from the first half of next year, US citizens, they are start to lose the jobs. Maybe they reduce the salary that they have for his things. And remember that right now the Grifols, they are paying $80-90 for donation. A US citizen can go 2 times a week for a donation. So at least right now you can win a range from $500 to $700 a month if you go to a plasma collection center. So Grifols is not an investment because Grifols has a high inflation cost because Grifols is who is paying the donor for the donation. But PaySign is just a credit card that the donor uses when they go up from the center and go to a bank and they take out this $80. So I think that the tailwinds for PaySign, it's really amazing. You can remember that PaySign goes from $19 to $1.5. Right now it's $3. And if you only value the plasma business, because PaySign have 2 other business, but if you only value the plasma business with normal, so think that PaySign right now has 40% of the market share of the market. They have only one competitor. Remember, his competitor was Wirecard, but Wirecard was bankrupt last year. So a US private equity, bought the plasma assets from that business. And this is a niche business. So I think total addressable market for this business is 100 million. So big players in payments are not interested to go into plasma business. So you have only one competitor. You are increasing agreements with donation centers. Right now you have 40% of market share. You can reach 60% maybe in 1-2 years. And the best part is that you are increasing the productivity of your centers after the COVID and after the lockdowns, because in the lockdowns, people cannot go to the street to go to plasma centers. So in brief, I think PaySign offer you one of the, in my opinion, one of the best opportunities, and you double your money in the next 6 months because it's trading at $3. And I think the plasma business, only the plasma business, is a range of $5-6 per share. So I think it could be a good opportunity. This is not a recommendation, so it's just my opinion. This is a disclaimer. But these are what I try to do. I like PaySign because they can offer me the KPIs that I need to model the business. I don't want to model, okay, PaySign is going to grow revenue this year 40%. No, I want to understand where are the key metrics that drive the revenue growth. That in PaySign is the productivity, average revenue per center, and the number of centers, right? Absolutely. It's just an example, Robert.
No, very good. Thanks for that, Quim. So, Maj.
I think what I like about that approach too, guys, that when you're in this time of uncertainty right now, that gives you some certainty to some degree, right? And I think those kind of stocks could get some higher valuation from the market because they may offer some certainty. So for those that know, KPI is key performance indicators. Yeah. And so what Kim's doing is going out to looking for companies that, publicly display some of these KPIs. And I think you also do some of that from some on the ground due diligence, Quim, or you getting it all from filings and stuff and press releases.
Let me explain the KPI. So in an easy way, if you compare Facebook and Google, there are a main difference. So Facebook is disclosing each quarter different KPIs, but the most important are monthly active users, MAU, and the average revenue per user. But if you look at Google are not disclosing anything. Just they said to you, okay, what is my revenue growth in advertising, and what is my revenue growth in other segments? So I'm not interested in that because I cannot model this kind of company. So if you take this one and go to small cap is where I'm doing. Sometimes you don't have the direct KPIs, no? For example, PaySign offer these KPIs, Medifast offer these KPIs, but sometimes other companies like Expel or Champions Oncology, they don't give you these KPIs. But this is why I'm saying indirect KPIs. So you can reach these KPIs doing some investigation, talking with competitors, customers, suppliers, different people. So you can reach this kind of information for internet. So sometimes it's easier to find this information because the company is disclosing each quarter or in the 10K in an annual frequency, but sometimes it's more difficult. But if you do the job and you are the only one that is doing the job in a small or microcap company without analyst coverage, I think you have something interesting that the market, they don't have. or they don't know, right? This is the idea, Maj.
Hey, Quim, real quick question, Maj, real quick on the idea of looking at the KPIs. Let's say you have a company that has multiple. Let's say they have 4 or 5. Do you have a number of KPIs that you look at specifically, or are there, if let's say a company has multiple and you only really care about 1 or 2, how do you discern which KPIs are most important to you?
In my opinion, maximum 3, 4. So more than 3, it's not. So think that KPIs can help you to understand the company. If you try to understand 25 KPIs, you are not understanding the company, right? The idea is to simplify the analysis. So I think 2, 3 is okay. So thinking, for example, I love royalty companies, right? So oil royalty companies, gas royalty companies, gold, silver royalty companies, because I don't like the cyclical part of this business, but I like the royalty business because is it cyclical, but is it less cyclical than oil companies? Is it really easy to model these companies? You only need to estimate realized estimated spot price for oil, gas, or something. You should be conservative, and then you should estimate the production, right? 2 KPIs, so it's easier. So Medifast, 2 KPIs, coach and productivity. Facebook, 2 KPIs, no? It's like ARPU, our average revenue per user, and number of users. So 2 or 3, it's okay.
Very good. And just real quick question.
Hi, Bobby.
Real quick, this is just my compliance, Bob, part. And so Kim, real quick, you mentioned a few names. Just wanted to make sure. So Medifast and PaySign, obviously you are a shareholder.
Yes.
And then Expel and Champions Oncology, not a shareholder.
I'm shareholder also.
Oh, you are a shareholder. Okay, good. All right, just want to be clear. Maj, take it away.
Yes, and I just want to reiterate that, Bobby, if you want to get more information on some of this conversation we're talking about here, I had interviewed Geo. We did about an hour podcast where we talked more about these. So he gives a lot of more case studies there, which is pretty awesome.
Oh, 100%. I actually checked out some of that. It was really good.
Yeah.
Really good.
He has like six stock pitches and more about his strategy and KPIs, and we talk about his course too.
Very cool.
But yeah, I just want to add one thing here too, is what I'm looking for now too, guys, is, and I really want to add more of the KPI analysis into what I do after talking to Kim. But I'm also looking for more than ever now just multi-bagger traits that I've more on the quality side and strategy side. And if I can combine in these companies that have worked well in the past, maybe if I combine that with some of what Kim is doing, that might actually even make it a little better for me. So I'm really trying to identify in this market right now where when you have more competitive markets and uncertainty, I'm really focusing now on companies that are really trying to get more wallet share from their current customers, and also finding ways to be more productive, more efficient. And I think that combination is going to be really interesting. It may be an easier way for a company to go out there and grow their revenue in this kind of environment when it's harder to compete out there. It might be harder to gain some market share. So I'm really excited that's a really big list I'm making right now. These companies that are really getting more wallet share from their own customers, and I'm really keyed in on that. So that's something I thought I wanted to share with you a little bit. It's been one of the, I've been doing this for so long. It's been one of those, if I was to pick my top 5 kind of multi-bagger traits, and that would be one of them. It's almost like a layup for a company. If you're able to, you might have 20 to 30% kind of under penetration in your current customer base, and then go after it. So that's pretty cool. You kind of see a lot of that kind of discussion in these conference call transcripts where they get a little more granular about the strategy. And that's where I'm kind of digging right now. I'm trying to find out in these transcripts those that are talking about that.
Literally, that was just what I was going to ask you. Right now, almost, everybody's already, announced their Q2s or, their results from this last quarter. From both of you, what are some of you just mentioned one thing, obviously, that you're looking for is some of the companies that are now really focusing on their own internal market penetration. Are there any other things that you're seeing from some of these recent conference calls and on the transcripts that, from companies that you like, that you're hoping to see more of from maybe new ideas, or that folks should pay attention to when they're assessing companies maybe that are in their own portfolios? Maj, let's go back to you first, and then we'll go to Ken.
Yeah, I'm really trying to really understand what companies understand the environment that they're in right now. I really want to know which teams really get what's going on now and have a really keen understanding of their markets. And I love those companies that have been around for a long time, because I can ask if they've gone through a similar thing in the past, how they've handled recessions. So I'm trying to kind of get an idea on that, right? But other than that, really, man, it's basically wallet share, understanding your markets that you're in, understanding the risks, and what are you doing to preserve and increase your margins. Those are really important things to me. And give me and I want to hear the worst case scenario. I want what could go wrong here. The mistake we can make as investors, like when we're having bad times like this, is get overly pessimistic. We can read conference call transcripts and say, I don't believe any management team, they're all BS, they all lie, they're all overly optimistic, which might be true to some degree. But there are some that aren't necessarily on that side of the pendulum, and that's what I'm trying to find. And I think they're out there, but to go into this thinking that they're always going to get it right is wrong too. Hey, they're not all going to be right with what they're doing, and they could be blindsided. But that's kind of where I'm kind of focusing on. And of course, I'm looking, as you know, I always compare conference call transcripts with press releases, see if there's any new tidbits of information in the transcripts. And something I did figure, was really kind of disheartening a little bit, because we read every single earnings press release from every nano-cap company that comes out in microcap, and they're coming out in a flurry. So then we have a chance to come back and reflect and read the transcripts. There is a lot of pessimism. There is a lot of pessimism out there for sure. The amount of companies that are reporting losses or not growing at all is really it's crazy. I don't know if I've ever seen it this much before, and it puts in perspective how crazy this market got in the last 15 years. And I'm concerned about a lot of these companies. And when you look at where the market is now in the pullback mode, it's the pullback. Yeah, it has. There's a lot of companies that are still just hemorrhaging money, crazy cash burn, a ton of debt. And I don't know how they're going to raise money in this market in any kind of favorable terms. So there's still got to be this flushing out, I think, phase of some of these other companies that have to go. And a lot of these are in the nano cap area. That we're able to raise money, willy-nilly whenever they want it. And it didn't matter if they were losing money. Well, now it matters. So, and the market knows it. The market, I was looking at one company, which by the way, I am short. I'll do STRY. I will disclose it. And I've been short since about, I think, maybe 350 or so. I think it's 220 right now. But they're losing I think $30 million a quarter. And it just on I think like a 9 million revenue base, or 6-9 million revenue per quarter. They're in a telecom business, and they're building out networks. And it was a SPAC, and I couldn't believe that these companies are still out there. And they actually have a shelf. They have a shelf out there, and they're sitting there just selling stock into the market when they want. And this is a really good example of a little information arbitrage on this company. So, and there is a talent when you start interviewing management teams and you start reading press releases. You have to assess management bullshit radar. Who's bullshitting you, right? And who's not bullshitting you. And you do that by at least, of course, I've been doing it for 30 years. So
it's still the hardest thing of all time. It really is. It doesn't get any easier.
So that's one great thing about being old. I've gone through, I've talked to a lot of these guys before and see the story. So I know when they're those that continually are bullshitting us. But to give you an example of STRY, they put out their, I think it was Q2, and it was a huge loss. Like revenues were up a lot, talking good things, and they said something like, "Yeah, we're making good headways in our capital raising type of goals," right? But then you go read the SEC filings, and they filed a shelf concurrently with, I think it was with different. So, and they didn't talk about What we really should have said was, we filed a $100 million shelf that we can sell into the market anytime. They didn't word it that way in the press release. The stock went up that day because, and then the next, when people started reading that, the shelf that they all sold it, brokerage firms cut their targets from like 10 to 5. They cut them in half, and the day after, by the way. So and it's obviously the conspiracy theory is these brokerage firms are letting their clients get out of it probably before they downgrade it. Get out here because there's a shelf here buried in the SEC filings. So that's an example of just really, I nitpick what these manager teams say. We're cautiously optimistic. What does that mean? So that's just another tell. They're setting you up for something bad, right? It's the way they hedge their comments. We're really excited about our company medium term. Okay, well, that tells me that there's going to be some short-term issues here. All this positive stuff. Medium term, we got some strategy, you're going to be great for the medium term. Well, that means you're probably going to raise a lot of money in the short term. So the investments we're making today are going to pay off in the medium term, which means, okay, well, you're going to lose money for the next several quarters, probably. These kind of small things, right?
Medium term's a new one. I like that one.
On and all of that stuff. And it really, I still get fooled. I still will end up believing a company's not going to raise money. They raise money 2 days later. It just happened recently. And it's really it's a cat and mouse game.
I know what you're talking about too.
Yeah. But I still am very big on the qualitative. And so I think you can compare the qualitative with the KPIs he's talking about, with your bullshit reader getting really good over time. That's you need to really that combination works really well right now, I think.
But Maj, like using that example, we won't say the name, but because I've been doing a ton of CEO interviews recently, and there's been a lot of it's mostly with pre-revenue companies, and a lot of them have been one of the main things that they've been saying. And this is a totally different type of investing, right? So I'm not saying this is what you guys do, but even for the companies that are revenue generating that might need to raise capital in the medium term, maybe not necessarily in the short term, but in the for the medium term. But let's say they do it a little earlier than normal, kind of thinking ahead a little bit of hey, things might continue to get worse. Was that bad of a decision for them to do?
No, there's a different thing between what's good for the company, what's good for the investor, right?
Of course.
And
you want to make sure that's aligned, obviously.
Yeah. So what I'm looking at for now is management teams that I believe that they're going to have to raise money because they just come down so much, but they still want to want to go through an acquisition strategy. Because remember, there's probably a great opportunity to acquire companies in this market too, where they're going to raise money, maybe hopefully above current prices, for example.
Right.
Show me that the person you're buying, right, has confidence that your stock is worth more than it is today. I don't mind people that come to raise money as long as it's used for great things, right? It's creative acquisitions, paying down some debt, maybe a little bit. But you just got it's the one thing. That's what they're here for. 90% of the companies out there are to raise money, take money from you. And your goal is to find out which ones don't want to do that in a way that's going to damage your investment. It's just it's a back and forth thing, especially in your smaller companies.
Right. All right. Kim, let's bring you back in here, man. Sorry about that. So, my original question was about, things that you're looking for on the conference calls, recent conference calls, transcripts, going into, in the environment we're in today. And as you said, you see the macro environment also getting worse. So what are some of the things that you're looking for, either from your own portfolio companies or potential new ideas?
So maybe the best way to explain that is with an example, right, Robert? So Maj before talks about market penetration. So where is the opportunity? For me, this is the main questions that I'm doing when I'm researching a company. So I think Medifast is a good example here. So first, I'm starting with, reading the transcripts, reading the press release, but looking at the history. If you look at the history, you can see that in 2015, 2016, there are something that changed the Medifast story. And the something that changes a new CEO is Daniel Craig. So first, when you are analyzing
Bond? No, I'm just kidding. Sorry.
But
I was gonna say, James Bond? No, I'm just kidding.
So when you are researching a micro small cap, so you have to talk with the management. Management is really important. And at that time, this new CEO changed the company and put the customer as a moat, as a competitive advantage of the company. But where is the opportunity? So Medifast is a 1.5 billion company, right? Market cap is $1,300 million. But if you look all the US, so I think US is 300 million people right now. I think 70% of the people could be some kind of obesity in the US, right? So then if you split that number and take that 50% of that number of people could be interested in a nutrition plan to try to reduce the weight. So you have at least 130 million people as a total addressable market opportunity. But the most important is right now, Medifast has less than 1 million customers. So Medifast is the best company because he's a multi-level company like Herbalife and something. But the difference is the business model because Medifast the coaches are not managing the money from the customers. They are not managing the inventory of the customers. If you look at Medifast, skincare, and this kind of companies, they are managing this kind of company. This is because it's not a clear business. But in the case of Medifast, I think all of these things are managed in the headquarters. But the most important is that market share today from Medifast is less than 1%. Medifast is growing really high in terms of coaches. Coaches, the people that support the customers. And think that you want to lose weight. You can buy different nutrition plans. So the product of Medifast is a commodity product. It's not different than Herbalife. So if you buy the bars or the nutrition plan of Medifast, it's not much different than the others. The difference is the business model because Medifast has coaches that helps to you in this process of losing weight. So I think the most difficult thing to lose weight is to have something close to you to help you and to lose weight. It's not just to buy some product or to enroll in a subscription plan. It's do that, but to have something to talk. And the main competitive advantage is the customers of Medifast, they transform to coaches. So the sellers, the commercial network of Medifast before big commercials, they are customers. This is really amazing. So if you take that Medifast can continue to execute as the same way that they are executing from the new CEO change in 2015, 2016, so they can take market share. And if they have less than 1 million and the total addressable market for only US, because this business is scalable to other countries, but only in the US, the total addressable market is 130 million. This is an amazing opportunity. So I think that Medifast in 10 years, maybe they can have a revenue of more than 10,000 million, right? So this is a scalable business. The business is cyclical because if you are in a recession, maybe you are not enrolling in a nutrition plan. Okay, here I don't like it that, but I can assume it's easy to model the numbers because you have KPIs, coaches, and productivity. You can, if you multiply, you reach the quarterly revenue. You have a skin in the game because business, the management has some kind of insider ownership. So you have this kind of attributes that if joined together makes a good investment, right? This is my idea. And then I'm follow with press releases, with transcripts. I'm follow for this information. Also, I'm used to talk with a company. But for me, to try to quantify the opportunity, I think it's the best that you can do because you are seeing that the future is really good, right? There are companies that they don't have opportunity or they are not in the good strategy to try to capture the opportunity. And I think this example is good to explain where I'm looking, right?
Absolutely. And actually that kind of hits on what Maj is also looking at too, is just seeing that the companies are just really focused on market penetration for what they're really looking for. Would that, if I had to summarize what you just said, would that kind of be more or less what you're really looking for right now?
You have other example that Maj knows maybe more than me, who is reprobate systems. The problem is that the execution is not really good. I think with Linda, Maj, I don't know why opinion, but with Linda it's better. But
It's better.
In reprobate systems, you can quantify the opportunity because it's really easy. So you know that who is CIPI, who is this kind of immunodeficiency. I don't know in English the name, but this kind of help me Maj with the name in English. So this kind of rare disease that you need to inject plasma. So, and these are a really good example to try to quantify the opportunity.
Yeah, and well, KRMD is a great. It used to be RAPR. They have that's very it's a pretty easy one to model.
Yeah,
there's a bunch of KPIs there that you can use to help you get there. But again, that was execution. They got lucky because in the beginning of their ascent, because the change in the health the Medicare billing, which basically was allowed them to start billing for what they did. They make home infusion therapy system. So but eventually, and they had the biggest market share for their indication of what they were doing. But eventually execution mattered. What was interesting there on that came out, I wonder, like the original management team was growing and the kind of things went sour when he was kind of pushed out of the company and the new team came in. I'm wondering how the original founder would have done in the business. He was a little more measured, I think, in his growth expectations. He wanted to grow consistently, but not take leaps and bounds, I think. I'm curious to see. That was a situation where you had the activists come in who wanted to grow the company faster. But yeah, that's a good one. Yeah, I like Linda right now. I like her. She's definitely. I think she's better than the prior. Because there was the original CEO, Andrew Cephalon. Then there was the middle CEO. I forgot his name, who came in I think in 2000, right before COVID, I think. And then you had Linda come in after that didn't work out. And Linda comes from Beck Dickinson. She understands the market. She came back to the roots of the company. And what she actually did was, it's a great example of what we were talking about earlier. She said, wait a second, we have this low-hanging fruit within our own market, which we haven't even exhausted yet. We have indications that we can basically infuse for that we're not infusing for yet, that we could do. So there was all this low-hanging fruit with their current kind of market that they weren't even addressing yet, with the current market, to get more wallet share right from it. So, and as opposed to expanding the market, which she also wants to do, but she understood that there's low-hanging fruit first here to go after. But I don't know what's going to happen with Quim. They're still, and they're investing heavily in the business. There's going to be some competitive pressures at some point, and there are right now. They're losing some money because of the investments they're making for the medium term. And but I'm wondering if they sell the company at some point here soon. I'm wondering if that's the best, because I don't think if you look at their growth, that they were growing 20-30% a year for several years. Now that growth rate's under 20%, and they're still selling at a pretty elevated price to sales ratio. They're losing money. So I'm wondering if this market isn't going to like the story that much.
Remember that? Do you remember when we talk about the international strategy of reprobate systems?
Right. Yeah.
And that's really, Robert, this is really good to talk. So my first approximation to that company is talking with the management, also with Maj, and said, okay, we have a good model here in the US. People is transitioning from intravenous to subcutaneous. So our device, mechanical device or device here in the US with low income and you don't have you have to pay for the health.
Kim, which company is it? Is this still Repromed or new?
Yes, it's the same. Yeah. So the other part of the strategy is to grow internationally. But when you are doing the Peter Lynch style and you are going to talk with doctors, you are going to your most proximal hospital here in the city. I'm said, okay, let me check with any doctor here in Spain that is doing this kind of business, right? So to inject the products of CSL or Grifols to treat the CIDP and CID immunos disease, right? So when I talked with a doctor, they said, okay, in the US, the mechanical device, because it's really cheap and people don't have access to the health, right? They have to pay for that. Is it good? But here in Europe, when you have access with all the health because the government is paying for you the health, we are not using mechanical devices. We are using electronic devices. We're expensive. So when I asked that doctor, they said, I never buy this product for my hospital because it's worse than electronic. So I think the strategy is good in the US, but it's not good in Europe, right? So sometimes you have to differentiate that one strategy is good in your country, but it's not good in another country. And I think Maj at the end, RepairMed Systems is going to focus only in the US. That's my opinion.
And it was interesting too, is after we had that conversation, the next quarter that came out, they talked about having issues in their international growth strategy. And what was funny too, Kim, is that the original, the founder, right? He had told me, because I met him in, I think at one of your conferences. He wasn't there, Robert, but he was at a conference that way. Sorry, I cheated on you, Robert. I left for a second to go talk to him at a medical conference, and he was like, man, I'm having international markets not as easy as I thought it would be. He understood that, and I think he was very, he was entering it very cautiously. So, but yeah, it was pretty interesting. I was like, what's Kim talking about? This isn't going to be an issue. And then everything blew up in one quarter.
That's awesome. That's awesome. Yeah. All right, and real quick, are we still both the shareholder in RepairMed?
I still have some left. Yeah, I mean, I had it's a really small position of mine because I bought it originally on like at 10, 11 cents, sold a lot of it in the $12, $13 area.
Nice.
And then I held some just for the takeout, maybe. We'll see.
All
right, I was emotional. That's why I kept it. I thought it was going to go to 30 in 2020 for no reason at all. Well, I want to basically, before we go here, Robert.
Real quick, Kim, are you a shareholder in RepairMed?
Not now. So I decided to sell the shares when I talked with the doctor. But I have to say that I remember that Maj and me interviewed Linda Thorby, and I like Linda, so I like how we talk. So if the business is improving in the future, I can do again shareholder, right?
Yeah.
And Maj, you're
but I will disclose I own a little bit of Pays because of Kim too, by the way. So I'll disclose that. So but I gotta bounce soon, guys. So let's talk about this class really quick. So
yes.
So I met Kim a few years ago, and it was all about investing. He's a geo-investing member, but then along the way, I guess he started a course in Spain in Spanish, an investing course, and basically everything he talked about today, KPIs, how to model companies, what to look for. It's a very extensive course, and he wants to bring that now to the U.S. and maybe just to Spanish-speaking investors in the U.S. So I'm trying to help Kim do that. Help him maybe work together with Geo. Maybe we'll eventually we'll put a course together with him, combine it with what he's doing plus my experience of finding multi-baggers and have like more of a very intense, qualitative and quantitative course. But so Kim, why don't you tell more? Try and give us a really brief input about your course. And by the way, on my podcast, I got a lot of information on this, so we can come back and talk. If you're interested in this, you can come back and hit me up at Geo, everybody, and we'll get you on board on that. So go ahead, Kim.
So the story starts 3 years ago when I decided to create my YouTube channel. So I tried to look at the YouTube with the Spanish channels, and I said, okay, there are a lot of YouTubers talking about how to value stock, but any one of them are a professional investor, and the ones that are professional are not talking in a really advanced mode. And I said, why not there are an opportunity to create a YouTube channel with a more advanced level for people that they have some kind of minimum level, but they want to increase his level of a fundamental analysis and to increase the success in his investments. It is how it starts. And then maybe 2 years later, the own subscribers of my YouTube channel, who is niche because it's only 3,500 subscribers, they said, okay, there are two main equity courses in Spain online, but they are so introduction courses. Why not to create an advanced course? And this is how I start to think in the course. And right now we are in the third edition. So the third edition is going to start in the 17th of October next month. So this is the third edition. We have very good acceptance for the first 2 editions. If anyone to look about that, they can go to the webpage. Is it in Spanish? Okay, but they can read the people that going to the school. I don't know the word in English, like
testimonial.
Reviews. You can say, testimonial, but reviews, no? So I encourage you to look for the reviews, but all the people is really happy. So if you want to learn in an advanced level how to model a company, I think this course could be for you. The structure of the course is 2 blocks. One is quantitative and the second one is qualitative. In the first one, I explained 3 different models. I explained the simple model or introduction model, which is a simplified financial statement with just 1 line of revenue, cost of revenue, gross margins, 1 line for total operating expenses for OPEX, and then goes down to net income and earnings per share. Then a second model, who is a tier 2 model or intermediate model. This is the model that I'm using more for my job when I try to evaluate and analyze companies. Because if you are investing in a company with a low capex, with low capital intensity, with low cash conversion days, with not much to working capital to finance, and with a low debt or negative debt, you don't need to calculate a discount cash flow model. It's not necessary because it's not easy to do that. So a tier 2 model is the same than a simple model, but you are segmentating, or you are separating the revenue line and the cost line. Remember our examples in Medifast, Facebook, PaySign, Expel, this kind of companies. So what are the key metrics that drive your revenue line? So you separate the revenue line in different KPIs, and then you do the same for the cost lines. I don't know, for example, if you are valuing FedEx, you can look that FedEx is giving you a fuel cost inside of total operating cost, and then inside of fuel cost, they are giving you the number of kilometers that the lords going for the freeways and the price of the petrol. So you can model that, right? Then you can apply a multiple, right? When you have the P&L, you can use multiplies like P, EBITDA, sales multiple, and then when you have a company that is highly leveraged, is really high capital intensity, so capex across total revenue, it's more than 5-6%, or the cash conversion cycle, for example, like Grifols, who is more than 200 days, or you have a big working capital to finance. In my opinion, you have to compute a discount cash flow. But the problem is that if you want to compute a discount cash flow, you have to estimate a balance sheet, and you have to estimate for the future a cash flow statement. That's not easy, and we expand in the course 4 hours learning the students how to model in an Excel this kind of financial statements. Then when you have the 3 different financial statements, the financial statement, so the P&L, the balance sheet, and the statement of cash flows, then you can decide if you apply a multiple to the EPS or you are implementing a discount cash flow model with 2 steps. I like to model 2 different WACCs. The first one is for the 5 years that I'm projecting, and here maybe I'm using a low 10 years bond rate or the equity market premium. But for the terminal value, I can do something more aggressive. and I can maybe put my macro view in the market. I can increase the bond rate. I can increase the risk premium. I can reduce the revenue growth and the cash flow growth. So this is the kind of do that we do in the first part. Then we are talking about SEC filings. So SEC filings are really important. Maj know that because you can find information in the SEC filings. You can reach more than 100 different SEC filings, and sometimes it's not easy to understand and read the SEC filings. So in the course, we're explaining more than 100 SEC filings. Then we learn how to use the consensus analysis to put in your model, how to use the guidance of the company to put in your model, how to play different scenarios for your model, like the bull, the worst, the base scenario. And then we move to the qualitative part of the course, who we are analyzing competitive environment, modes, competitive advantage, this kind of things. Then we share about how to reach for multi-baggers, who is Maj talking before. And then we move to how to learn accounting and business for, especially to read 10 key. So sometimes people don't understand a 10 key. So when you are going to the notes that explain the financial statements, people maybe they understand something. I give you an example. Teladoc, the price of Teladoc is down 90% or 95% from the maximums. And there are one reason. So what are two reasons? The first one is because high growth stocks are really penalized and they go down. But the second one is in 2018, Teladoc buys both Livongo, who is the mental care business, and they pay with shares, but they pay 14 billion for that company. So when you analyze the fair value of the transaction, the price paid for that company was 14 billion. But try to guess, when you look at not today, but if you read the 10 key at the end of 2021, and you go to the balance sheet statement, where you can see is that the total assets number, 97% of the total assets was in goodwill. That's a red flag, because it's telling you that Teladoc, it's paying too much for the future synergies of Livongo. If you read at that time the financial statement, the 10 key, the note related to the goodwill, you can search that Teladoc is advising you that maybe in the future is obligated to do an impairment, because the conditions, the multiples paid for this business, the revenue growth of this business, the discount rate used in this business are not working really well. So they have to reduce the multiple, they have to increase the discount rate, they have to reduce the revenue rate. So if you read in this long text and really difficult to understand, you can maybe prevent a 90% downturn, because you can read in advance. Remember that at the end of first quarter of this year, Teladoc announced 7,000 impairment. So this is more than half of the 14 billion of the price paid. But at the second quarter, they add 3.5 billion more. So they eliminate 10 billion of the 14 billion that they used to pay for that company. So if capital allocation is okay, Teladoc is not an investment company. So this is not a recommendation, it's my opinion. So what I want to do is, in the course, we learn students to try to read this kind of difficult, long, not really easy to understand information. So
very good.
And then, at the end of the course, we learn how to model different business in different sectors, like how to model a mining or a royalty company or a tech company or a bank or an insurance company. So
cool.
This is the course.
Overdrive, man. That's awesome. I wish I spoke Spanish.
Yeah, right. I think I'm going to learn Spanish by going on the course.
Yeah.
But Quim, thank you for giving that full overview. I mean, if listen, if you like what you heard just now, definitely go and check out the course. I think it's on I think you have a premium version. Then also you have some stuff on your YouTube channel as well. Because I think, to summarize kind of our full conversation, along with the course, to go check that out. But, right now, focus on KPIs. There's pessimism, better understand what management teams are having to say about current market conditions and where they're going in the short term and or now medium term. And I think those are two really key, crucial, important things to think about right now when you're evaluating your own portfolio, as well as maybe potentially analyzing new investments. And also to, maybe go and subscribe to Geo Investing and check out what they got going on there, because some interesting stuff going on over there. Yeah, I got you.
Yeah, we should do an update a couple of weeks, talk about what's new at Geo and some new things I'm doing. So
100%.
Cliffhanger. Leave the cliffhanger. There's something really awesome I'm working on, so I can't wait to talk about it for next time.
Hey, you're always welcome back on, both of you guys, of course. So with that, where can everybody go and find more information? Maj, you first, and then Quim, where can people find more information?
Yeah, so geoinvesting.com is our website. You can send me an email, maj@geoinvesting.com, if you want to learn more about Geo or Quim's course. I can send you some clips and the full video, everything we talked about, and how to subscribe to his course. On Twitter, Maj at Maj Geo Investing. You can follow Geo Investing's Twitter handle is at Geo Investing.
Very good. And Quim?
Okay, so you can reach me in Twitter like with my name. The first one is surname Abril and then Quim, or for the fan's name, who is Draco Global. Also, you can reach me in YouTube with my YouTube channel, who is in Spanish, is Invertir como un profesional Draco TV. So this is the name of the channel, but if you write in Google, you can follow really easy. And then, this is the most common the social networks that I'm using.
Very good. And Quim, real quick, there was two more stocks that you named, Facebook and Teladoc. Are you currently shareholder in either of those?
No, not now. I decided to sell the Teladoc before the first quarter reporting, right?
Gotcha. All right. Well, with
good timing.
Yeah,
so
I think so.
Robert, the idea is for Teladoc, the problem could be goodwill, but for the other company, maybe it could be inventories, or could be cash, or could be prepaid expense, or could be unearned revenue. The idea is to choose the thing that you go to the in deep in terms of red flags, right?
Absolutely. I think that's a great place to end it. Guys, thank you for joining me today. Really do appreciate it. And I look forward to our next update.
Thanks, Robert.
Thank you.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.